Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, hope all of you are doing absolutely fine and preparing well for the examination. In this video, we will be revising quickly and thoroughly to ensure that you have a recap of all the important concepts that are required for the examination. So without wasting much of a time, let us start. First one is IndAS 2 on inventory. Now as far as inventories are concerned, inventories comprise of finished goods, work in progress, raw material and supplies. The most important thing that you have to remember here is inventories are measured at lower of cost and net realizable value. Now what is cost? For cost we will include, what all will we include? We will include purchase price, we will include import duties and taxes. If they are refundable, we will exclude them. Then we will include transport and handling charges and any other cost to bring the inventory to present condition and location. We will deduct trade discounts, rebates and other similar items. So this is as far as the cost is concerned. Then when it comes to cost of conversion, direct material, labor and any other direct cost and overheads. Now when it comes to overheads, very importantly what you have to keep in mind is, then when it comes to overhead absorption, what you have to keep in mind is, if the actual production is greater than the planned production, we will recompute the ORR. What is ORR? Overhead recovery rate. Normally ORR is your budgeted overhead divided by planned or normal production. This is the normal formula. But if actual production is more, we will recompute the ORR. If the actual production is less than the normal production, we will use the predetermined ORR. We will not recompute the ORR. Sir, what about the balance overhead which is not absorbed? That will transfer to the P&L. So this is one thing important what you have to keep in mind. Then any other cost which is incurred to bring the inventories to present condition and location, this will be a part of cost of inventory. And borrowing cost, if it is a qualifying asset, then as per IndAS 23, we will capitalize the borrowing cost as well. Okay. Then the next thing what we need to compute, net realizable value. Net realizable value is your selling price minus estimated cost to compute, estimated cost to complete and estimated cost to sell. So they will give you that selling price is 100, cost to complete is 20, commission on sale is 10. So 70 becomes your net realizable value. Lower of cost and net realizable value should be the value of your inventory. Sometimes for computation of NRV, if there is a firm contract with the customer, then that rate can also be taken. Then you have the concept of joint and byproducts. Joint products, they are two or more products which are produced from a single process using common inputs. Both the products are valuable. Byproducts are low valued products. Generally they are considered as scrap. Now what do we do with the joint cost? Joint costs are allocated on the basis of relative sales value or net realizable value at the split off point. What do we do with the byproduct? Whatever revenue you get from the byproduct, you will reduce from the cost of the main product or you will reduce from the joint cost. Then there are some cost formula which are prescribed, more important for MCQ purpose. Once in a while they ask, using the retail method and all, but otherwise it is not very important. Valuation method, inventories which are not ordinarily interchangeable, we will use specific identification of cost. If they are ordinarily interchangeable, then we will either use the historical cost method which is FIFO, weighted average, or we will use the non-historical cost, standard cost or the retail method. Now retail method is basically, you will take the selling price, you will reduce the percentage gross profit, then you will get to the estimated cost. Then when it comes to raw material valuation, whenever you get a question for inventory valuation, 100% they will ask for raw material valuation, and here very importantly, if the finished good selling price is more than the cost, raw material is valued at cost. But if the selling price of finished product is less than the cost, then you will value it at replacement cost, which is a representative of the net realizable value. Now don't take that it is cost or replacement value, whichever is lower, not that way. If the selling price is less than cost, then you will write it down to replacement value. Now this replacement value, if it is greater than cost, then you will always value at cost only. So basically, only if the raw material prices have fallen and also the finished goods prices have fallen, then you will value it at replacement value. Then as far as IndAS 2 also specifically requires us to show what is the expense that is charged to P&L. So basically cost of goods sold is your opening stock plus purchases plus other manufacturing cost minus closing stock. So this is the cost of goods sold. Then moving on to the next standard, which is IndAS 16 on property, plant and equipment. Now as far as property, plant and equipment are concerned, they are the items which are held for use in production or supply of products or for rental or administrative purposes. Rental of your land building component which is held at investment property, which is covered by, this will be covered by IndAS 40, and it is expected to be used for more than one period. You can just remember the definition. Then bearer plant is also considered to be an item of property, plant and equipment. Bearer plant is a living plant that is used in the production or supply of agricultural produce, is expected to bear produce for more than a period of 12 months and has a remote likelihood of being sold as agricultural produce except for incidental scrap sales, right. So, for example, mango tree, orange tree and all of those things, those are your bearer plant. Bearer plant are covered under IndAS 16. Then how do we compute the carrying amount? You will take the gross book value, this is nothing but your cost, minus accumulated depreciation and accumulated impairment loss. This you will understand in IndAS 36. Now, what is the recognition criteria for PPE? It should be probable that future economic benefits associated with the item will flow to the entity and the cost of item can be measured reliably. Similar conditions you will learn in IndAS 38 and also IndAS 40. If there are spare parts, standby equipment and servicing equipment, if they meet the definition of PPE, they will be measured as per IndAS 16, otherwise they will be measured as per IndAS 2. Now, how do we do the measurement at initial recognition? It can be, now there could be multiple scenarios. One is you directly pay by cash or it is taken on credit. If there is a self construction and there is an exchange of monetary asset. If it is by cash, whatever amount you have paid, at that value you can recognize. If you have transferred some asset, that will come under this criteria. If it is self construction, then you will add all the construction cost and calculate the value of PPE. Now the next question is, what is the cost of an item of PPE? You will take the outright purchase price, then non-refundable taxes and duties, initial delivery and handling charges if it is given, cost of site preparation if you have to prepare the site to install the machinery, installation and assembly cost, professional fees, this is for design and all of those things, borrowing cost if permitted by IndAS 23, then cost of testing minus net sale proceeds. If there are any cost of testing to make the PPE ready for its use, that also you will capitalize, but if there are any incidental sale proceeds while cost of testing, that will be reduced. Now here one thing you have to keep in mind is, if net sale proceeds is greater than the cost of testing, the amount is deducted from the cost. So if the sale proceeds are greater, then you will treat it as a reduction from the cost. Then very important, present value of decommissioning and restoration cost in accordance with IndAS 37, that is, if I have to carry out some decommissioning activity after let us say 15 years or 20 years at the end of the useful life, the present value of that should be considered. Now generally, whenever IndAS 16 question is asked, this point is definitely covered in the question. Then any other cost to bring the asset to the location and condition necessary to operate for its purpose intended by the management. So to bring it to its condition and location as intended by the management, that should be considered. You will reduce any government grant which is received specific to the fixed asset as per IndAS 20 and trade discounts and rebates if it is already included. So this is your cost of PPE to be classified. What are exclusions? Important from your MCQ point of view. Cost of conducting business in a new location or with a new class of customer, any cost incurred in introducing a new product or service, cost of opening a new facility, ribbon cutting and all, administrative and other general overhead expenses. Then if it is a self-constructed PPE, apart from the cost that we have discussed above, you will also take cost of construction that is directly related to the specific asset. Please note, you will take only the cost, you will not add profit element to it. Cost that can be attributable or allocated to the construction activity, borrowing cost if it is a qualifying asset. You will not take, as I told you, profits and the cost of abnormal amount of wasted material, labor or other resources. So even in inventory, abnormal amount of wasted material, labor and resources, they are excluded. If it is an exchange of non-monetary asset, then you have to see whether the transaction has commercial substance or not. So generally, if same type of assets are exchanged, they don't have commercial substance. But then if it has commercial substance, then you have to see whether you can measure the fair value of asset acquired or given up. If it does not have commercial substance, you will directly take the carrying amount. If you don't have the fair value, then also you will take the carrying amount. So if fair value is not available for either asset given up or asset acquired, take carrying amount. If it does not have commercial substance, take carrying amount. But if fair value is available, then the first preference is fair value of asset given up or fair value of asset received. If both are available, take the one which is more clearly evident. So basically, finally the conclusion is take the one which is more clearly evident. So if both are evident, then fair value of asset given up is the first preference, because that is the amount you are actually paying to acquire the asset. Then when should we stop capitalization? We should stop capitalization when the PP is in the condition, location condition necessary for it capable of operating in the manner intended by the management. So when the management thinks that yes, it is in the condition and location for being operated, at that point of time you will stop the capitalization. Subsequent cost, if it is day-to-day repairs and maintenance, you will charge it off to P&L. If it is replacement of parts of PPE, then what you will do? You will de-recognize existing component and you will capitalize the new component. Major inspections and overall, they are capitalized. Then very important, if asset is acquired on deferred credit terms, then you will take the cash price or you will consider the present value of deferred payments. Sir, what about the difference? The difference is considered as interest expense and it is added, or it is considered as a part of your borrowing cost. And as per IndAS 23, if it is a qualifying asset, then you will add it to the asset, otherwise you will just expense it off. Then comes depreciation, very simple. So depreciation is calculated based on the depreciable amount, that is your cost or revalued amount minus the estimated residual value. When should we start depreciation? When the asset is available for use, not when the asset has been not when the entity starts using the asset. When the asset is available for use, on that date you should start charging depreciation. And when you stop depreciation, either it is classified as held for sale or on the date on which it is de-recognized, means I have stopped using it, on that date I will stop charging depreciation. Then if the asset has components which have different useful life, for example in case of an aircraft, engine may have a different useful life, the seats may have a different useful life, then in that case what do we do? For seats we will charge depreciation separately, for aircraft we will charge depreciation separately, that is called component accounting. Then there are different methods of depreciation, straight line, diminishing balance, unit of production method, this you would be aware of anyways. Now coming to depreciation on an addition or extension to an existing PPE, means I already have an asset, I have added something else. Then if it cannot be used independently, you will depreciate over the remaining useful life of existing asset. Means let's say I have a two-wheeler, I have added one more seat to it, okay, making it a 3-seater. Then if it cannot be used independently, depreciate over the remaining useful life. So in my case I cannot use it independently, so I will depreciate it over the remaining useful life. If it is independent and has separate identity, depreciate independently on the basis of its own useful life. Measurement after recognition, cost model is straightforward. Main important is revaluation model. Now what is revaluation model? Revaluation model basically means that I am carrying the property, plant and equipment at its fair value and not using the cost model. So in this case there are two ways to do the revaluation. One is depreciation elimination approach. Basically you will take the cost, depreciation, carrying amount. Let us say cost is 1000, depreciation is 200, carrying amount is 800. Now we have revalued to 1200. Then what you will do? You will eliminate this depreciation and from 800 you will move it to 1200. The other one is restatement approach. In that case what do I do? 800 I will make it 1200, that is an increase of 50%. So this I will make it 1500 and this I will make it 300. So this is called the restatement approach. Now the most important thing is how do we treat revaluation? If it is first time revaluation and if it is an upward revaluation and there is a gain, we will credit it to other comprehensive income as a revaluation surplus. Then if it is downward revaluation, if it is a loss, then charge to P&L. This is for the first time. So upward revaluation, increase the value of PPE, credit to revaluation surplus, downward P&L to PPE. Subsequent revaluation, that is where things become tricky. If first time is upward revaluation, first time upward, then if subsequently also it is upward, add to revaluation surplus. If subsequently it is downward, then whatever is available in revaluation surplus for this asset, use it, use the existing surplus and balance charge to P&L. Please remember, this surplus has to be of that specific asset only. You cannot use other assets revaluation surplus for this purpose. If First time it is a downward revaluation. Initially it was downward, subsequently it is upward. Then what do? Whatever we had charged to P&L, to that extent we can credit to P&L and balance to revaluation surplus. Subsequently if it is downward, then the amount will be debited to P&L. Then what do we do with the revaluation surplus? Periodically, considering the difference between original depreciation and revised depreciation, you can transfer that amount to retained earnings, or when the asset is derecognized, at that point of time you can transfer to the retained earnings. When do we derecognize? When the asset is disposed, means we have sold, discarded, scrap, or when no future economic benefits are expected from its use or disposal. We will not get any future economic benefits, then in that case we will derecognize the asset. Then there is a specific guidance in Appendix A related to changes in existing decommissioning, restoration and similar liabilities. So here what you have to keep in mind is, if whatever is the change in liability shall be added to or deducted from the cost of the asset in the current period, and decrease in liability cannot exceed the carrying amount of the asset. For example, liability is 100 and carrying amount of the asset is 50. Okay. Now this liability, if it has come down to 20, I cannot reduce this. I cannot reduce it more than 50. I cannot make it negative. So if the decrease in liability is greater than carrying amount, excess has to be recognized as income. Only this thing if you keep in mind, it is more than sufficient. Then moving on to the next one, that is intangible asset. IndAS 16 tangible, IndAS 38 intangible asset. Now intangible asset is an identifiable non-monetary asset without physical substance. There is no physical substance. Example could be trademark, newspaper, internet domain names, non-competitive agreement, customer list, customer contracts, trade secrets, patents. All of these are examples of intangible asset. Now just because I have written customer list does not mean I will recognize it. This is an intangible asset. Whether I will recognize it or not depends on the recognition criteria. Now when it comes to intangible asset has to be identifiable. Identifiable means I must be able to identify or separate, saying that yes, this is the intangible asset. How will I identify? Either it is separable. Separable means I can detach that intangible asset and sell it separately. That is called separable. Or it has come from contractual or legal rights. Contractual right means, for example, I have taken a 5-year license of something. Okay. Now based on the contract, I have received an intangible asset or I have acquired an intangible asset. So that is out of contractual or legal rights. Second condition is separable. Separable means, for example, if I have a patent, I can sell off that patent separately. That is what is called separable. Goodwill is not separable. Goodwill is not separable from the business and hence is not identifiable and is not recognized as an intangible asset under IndAS 38. Goodwill is recognized under IndAS 103 when there is a business acquisition. An asset is identifiable if it is either separable from the entity and can be sold, transferred, licensed, rented or exchanged, or arises from contractual or other legal rights. Then second thing is, it has to be non-monetary. Non-monetary means assets which are not monetary. What are monetary assets? Monetary assets are those assets whose value is fixed in terms of money. For example, account receivable. I know I have to receive 100 from a customer. That is a monetary item. If I don't know what is the value that I will receive, it becomes a non-monetary item. Okay. So intangible assets are non-monetary items. That is why debtors, account receivables, loans given and all of those things, these are not intangible assets. Then what are those? Those are financial assets which is covered under IndAS 32 and 109. And it should not have physical substance. Then sometimes you have intangible assets like software, which is encoded in a CD. In that case, though this is tangible, the software is intangible because software is the substance of the entire asset and hence it is considered as intangible asset. When do we recognize intangible asset? Future economic benefit, and we can measure the cost reliably. So it has to be non-monetary, non-physical, identifiable, future economic benefit, and cost can be measured reliably. Then that is when you recognize intangible asset. Then how do we measure the intangible asset? The cost of the intangible asset which is purchased is your purchase price, same like IndAS 16. Non-refundable taxes, installation cost, professional fees, borrowing cost if permitted by IndAS 23, very unlikely. Then any other directly attributable cost to bring the asset to the location and condition necessary to operate for its purpose intended by the management. So decommissioning, there is nothing called decommissioning in intangible assets. Then government grant received and any other trade discounts, if it is related to the intangible asset, you will reduce. Then very important, cost for internally generated assets. See, purchase means I'll just take the purchase price and be done with it. If it is internally generated intangible asset, then goodwill which is internally generated is not recognized. Goodwill which is internally generated is not recognized. Then cost on research is always expensed. If there is an internally generated intangible asset, the cost on research is expensed, cost on development is capitalized if 6 conditions are met. What are those 6 conditions? These are the 6 conditions. Number 1, technical feasibility for completion of intangible asset to make it available for user sale. So the entity has to demonstrate. Yes, there is technical feasibility to complete the intangible asset and make it available. Intention of the entity to complete. So it must be feasible. I must have the intention. Ability to use or sell the intangible asset. Fourth one, demonstrate generation of probable future economic benefits. Fifth one, adequate resources are available. And sixth one, measure reliably the expenditure attributable to the intangible asset during the development. So if these 6 conditions are satisfied, in the development phase, you will capitalize. If any of these conditions are not satisfied in the development phase, you will expense. Research, always expense. And please keep in mind, once it is expensed, you will not bring it back in the books as an intangible asset. What all costs will you include? All the costs which are attributable, like material, cost of services used, employee cost, legal expense, any other intangible asset which are used for making the intangible asset. So this is basically your amortization. Then borrowing cost, exclusion, selling overhead, indirect cost, initial operating losses due to inefficiency, staff training cost. If there is exchange of non-monetary asset, again same thing what you have done in IndAS 16, same thing is applicable. If intangible assets are acquired in the form of government grant, so if the government gives you intangible asset, then they should be valued or capitalized in accordance with IndAS 20, that is either using the nominal value or fair value. This will understand in IndAS 20. Any subsequent expenditure on intangible asset, you should expense it unless it increases the future economic benefits. Let's now move on to the next part, that is amortization. Amortization for intangible asset is similar to your depreciation for tangible asset. So here also you will need your residual value, which will be either given to you in the question. If it is not given, you will assume it to be nil, and systematically over the useful life of the intangible asset, you will amortize it. Please note, goodwill cannot be amortized. Goodwill, you will do impairment testing annually. Okay. As I told you, generally residual value of an intangible asset is assumed to be 0, and we will review the change in estimate of residual value at the end of each accounting period. If residual value is higher than the carrying amount, then amortization amount will be 0. Same thing will apply in depreciation also. If the residual value has become greater than the carrying amount, then you will no longer charge depreciation. Now, as far as useful life of intangible asset is concerned, you have either a finite useful life, that is a fixed useful life, or indefinite. Don't write infinite, it is indefinite useful life. Indefinite means we cannot determine the useful life. If it is indefinite, then what happens is amortization is not possible. Amortization is not possible, and hence here you will apply impairment. We will understand about impairment in IndAS 36. Whereas if it is finite, you will amortize it over the useful life. Then sometimes we have intangible asset which come out of contract. Now there will be a contractual term and there will be a separate useful life of the intangible asset. Now for depreciation purpose, the useful life that you will consider cannot be greater than the contractual term. So if I have a contract for 5 years, I cannot depreciate it for more than 5-year term. Then sometimes we have cost of renewal. So you might have taken an intangible asset for a specified period of time. Now you want to renew the intangible asset. If the cost is significant, you will consider it as a new intangible asset. So basically what you will see is the cost you are incurring on the intangible asset renewal and what is the benefit you are getting. Accordingly, you will see whether the cost is significant or not. So renewal costs are considered significant or not in comparison with the additional economic benefit received by the entity during the renewal period. So what is the additional economic benefit that you will get in the renewal period? If that is significant, if the cost is significant, then you will consider it as a new intangible asset. If cost is not significant, then the renewal period also will be added to the original useful life and renewal cost will be expense. So basically what you need to remember, if it is not significant cost of renewal, you will expense the renewal cost, important from MCQ point of view. Then coming to amortization, amortization can be done only for asset which has finite useful life. If it is indefinite, because you don't know the useful life, you can anyways not calculate amortization. When do we start amortization? When the asset is ready for use, similar to the conditions or similar to the situations learned in IndAS 16. And when do you stop it? Either it is held for sale or asset is derecognized. Same concept, nothing new. Now, one thing you have to keep in mind for both depreciation and amortization, if there is a temporary stoppage of usage and all of that, you don't stop charging depreciation or amortization. Can be a small 1 mark question or 2 mark question for MCQ. Then as far as amortization methods are concerned, you can use straight line method, you can use diminishing balance method, you can use unit of production method. One very important thing you have to keep in mind is revenue generally cannot determine the pattern of consumption, and thus revenue cannot be used as basis of amortization. So generally revenue will not be used as basis of amortization, but there is an exception when the contract specifically states that the revenue is the limiting factor. Means, for example, you will be able to use the asset till you achieve some amount of revenue. If that is the case, then revenue can be a depreciating factor. Then amortization can be done based on revenue as well. And if the revenue has high correlation with the consumption pattern, revenue has high correlation with the consumption pattern. So in two situations, one, revenue has a high correlation with the consumption pattern, or revenue itself is the limiting factor. In that case, you can use revenue. The amortization method should be reviewed at least at the end of each year end, and change in amortization method or change in depreciation method is treated as change in accounting estimate, not a change in accounting policy. If intangible assets have indefinite useful life, then you are required to test for impairment annually or whenever there is an indication that the asset may have been impaired. This you will learn in IndAS 36. Then as far as subsequent measurement is concerned, you can use the cost model or the revaluation model. Again, same concept what you have learned in IndAS 16, here also the same thing is applicable. Then coming to derecognition of intangible asset. Intangible asset is derecognized when no future economic benefits are expected or the asset is disposed by the entity, similar to the conditions that we have learned in IndAS 16. Then you have disclosures, you can run through it once. Specific exclusions, if it is an item of inventory covered by IndAS 2, deferred tax asset covered by IndAS 12, leases of intangible asset 116, asset arising out of employee benefit IndAS 19, financial assets 32 or 109, goodwill 103. Please remember, goodwill is not covered by IndAS 38. Then non-current assets held for sale IndAS 105, assets arising from contract with customers 115, and mineral oils ores 106. So that is about IndAS 38. Now moving on, a few specific things. Sometimes you get a question on advertisement campaign. They have spent a lot of money on advertisement campaign. They will get future economic benefits. Can we capitalize that as an intangible asset? We cannot capitalize unless it is a prepaid expenditure, kind of, let us say there is a 12-month contract period and you have done a prepayment. That is a different thing. But amount already spent on things like advertisement and all of these things, they cannot be recognized as intangible asset. Similarly, internally generated goodwill, internally generated brand and all of those things are not recognized as intangible assets. Then the golden rule you have to keep in mind, research expenses always expensed. Development capitalized if those 6 conditions are fulfilled. If you have already expensed something, you cannot again recapitalize it. Right. So that is about IndAS 38. Moving on, IndAS 40, investment property, very, very simple standard. Investment property is what? Investment property is property, land or building held by owner or lessee to earn rentals or capital appreciation. So objective is rental or capital appreciation, and you have land or building or both. This property will be classified as investment property if you are using it for rentals or if you are using it for, or if you are holding it for capital appreciation. Now one key thing that you have to keep in mind to distinguish between what comes under IndAS 16 and what comes under IndAS 40 is that if my objective is to use the property for my office purpose, for for my employee's occupation and all of that, then in that case it will come under IndAS 16. But if my objective is to earn rental, if my objective is to have capital appreciation from that building, then that will be covered under IndAS 40. Most of the accounting treatment is similar, just that under investment property, revaluation model is not permitted. You will use the cost model only, but you may have to make certain disclosures based on fair value, for which you need to compute the fair values, but accounting will be done using the cost model only. Depreciation, same what you have done for IndAS 16, same thing will apply here. Impairment will be applicable. Only thing is that revaluation model is not permitted. So, what are not investment property? Property held for use in the production or supply of goods or for administrative purpose, including property occupied by employees. So, if my employees occupy my property, I may be collecting some nominal rental or proper rental for them. That is not my investment property, because the objective is to use it for the business. The objective is to use it for the business. The employees are for the business. But if I am having a property which I continuously give it out on rent and I hold the property so that in future when the value appreciates I will get more money, that is covered under investment property. Property held for sale in the ordinary course of business is covered by IndAS 2. Right? So, properties which are covered under IndAS 16 or IndAS 116 as a right of use asset, these are called owner occupied property and not investment property. Now, sometimes the property can have dual purpose, means more than one purpose. Then what you have to check, can we split the property? Split the property means I have 10 floors. Out of that 7 floors is for my office purpose, 3 floors is for renting out. So, first 7 floors IndAS 16 and the remaining 3 floors IndAS 14. Then if split is not possible, I have a single floor, I cannot split it, but I keep on giving some part of it as on rent. Okay, in that case, if the owner occupied portion is significant, then it is PPE. If it is insignificant, then it is investment property. Then, if a property is given to rent to group companies, in the standalone financial statements, you will show it as investment property, but in the consolidated financial statement, it will be treated as property, plant and equipment, because for the group, you have not let that property outside the group. Some examples: land held for long-term capital appreciation, very important, land held for currently undetermined future use. I have a land, but for what purpose will I use it in the future? I don't know. Then in that case, it becomes an investment property. Building owned by the entity and leased out under an operating lease, this also is my investment property. A building which is vacant and is held for leasing out, this is also investment property. Property under construction which would have been held as investment property in future is also an investment property. Coming to recognition criteria, same as IndAS 16, future economic benefits and cost can be measured reliably. Then, how do we measure at recognition? At cost. Cost is again same thing what we learn as a part of IndAS 16, purchase price, non-refundable taxes, site preparation, construction, professional fee, borrowing cost, any other direct cost attributable to bring it to the condition necessary to operate for its intended purpose, less government grants and trade discount. If investment property is acquired on deferred credit terms, then you will take the cash price and the balance will be your finance cost. Then, if you acquire investment property by exchange of non-monetary asset, same principles of IndAS 16 would be applicable. Now, in some cases what happens is, initially I may be holding the property for one purpose, subsequently my intention has changed. In that case, what do? We can move from IndAS 40 to IndAS 16 when the owner occupation starts, or you have started development with a view to owner occupation. Means I want to occupy the property, then from IndAS 40 you will move it to IndAS 16. Then there could be a situation where we want to develop with a view to sell it in the ordinary course of business, then it becomes inventory. From IndAS 16 to IndAS 40, that is, it is an owner occupied property. Now we have vacated that property, we want to use that property to let it out. Then in that case, you will move it to IndAS 40. Then from IndAS 2 to IndAS 40, if we have started, say for example, a lease, it was an inventory, but now we have decided we will not sell it, but we will give it on lease to another party, then you will move from IndAS 2 to IndAS 40. Then coming to derecognition, similar criteria as what you have learned in IndAS 16 and 38. Disclosure, one thing we have to very much keep disclosure. You have to keep one thing in mind, especially for this standard. There have been a question which is likely to be tested in the examination. That is, what is the amount recognized in P&L for rental income, direct operating expenses, and direct operating expenses related to IP which did not generate rental income. So this disclosure is required, and one more disclosure that is required, important, is fair value of investment property, or why fair value cannot be measured reliably. So these things you have to disclose. That is about IndAS 40. Now moving on to the next standard, a very, very important standard, borrowing cost. Now here from this standard, generally you will get capitalization question, that is, what is the amount of borrowing cost to be capitalized? That is the question which has been tested, and here you have to be careful about what do you do with the general borrowing and what do you do with the specific borrowing. If you are through with this, the remaining part of the standard can be handled easily. Now, what does borrowing cost include? Interest expense, that is the interest you pay to, let's say, bank or something else. This is calculated as per principles of IndAS 109. Then interest in respect of lease liability in accordance with 116. An exchange difference on foreign borrowings to the extent they are regarded as adjustment to interest cost. Here also make sure you practice one or two questions on exchange differences. Now, whenever we have to calculate interest, we will follow the effective interest method that is prescribed under IndAS 109 financial instruments. That is, you calculate a rate that provides us what is the effective interest rate, or we also refer to it as IRR for the entire stream of cash flows. Very important part, exchange differences on foreign borrowings. So whenever there is exchange difference on foreign borrowings, there the standard says there are two components. One is the exchange difference which offsets the savings in interest. Generally what happens is, in US, let us say if you have to borrow, the interest rate may be 2%. In India, if you have to borrow, the interest rate may be, let us say, 8%. So borrowing in US is cheaper, but when you repay the US loan, exchange rate would have gone from 80 to, let us say, 85. So you actually pay a higher amount. This 80 to 85, this difference is called exchange difference. The change from 80 to 85 is called exchange difference. So for example, if a company borrowed $20,000 at 3% on 1st of January when $1 is 75. Interest and loans are repayable on 31st December. On 31st December, exchange rate is 78. So what happens? 75 to 78, this 3 rupees movement is called exchange difference. On 20,000 into 3, you have an exchange difference of 60,000. Now, what the standard says, out of this 60,000 of exchange difference, part of it is actually compensating the interest that I have saved. So interest, if you see, here it is 3% and INR funds can be borrowed at 6%. So we are actually paying less interest. We are paying less interest, but we are losing on exchange rate. So what you have to do, this 60,000 is exchange loss and interest cost on the loan is $20,000 into 3% into 78, which is 46,800. That is the interest you have to pay. If you had borrowed the funds in INR, borrowing cost would have been 90,000. So if you take INR loan, borrowing cost or interest is how much? 90,000. Because you have taken a foreign currency loan, the cost is only 46,800. Now you have saved something here, but then you are paying 60,000 as exchange difference. So what the standard says is, to the extent of this difference, that is 90,000 minus 46,800. 90,000 minus 46,800 works out to your 43,200. 43,200. This 43,200, the difference between INR cost and foreign cost, to the extent of this amount, exchange difference should be treated as borrowing cost. Means out of this 60,000, 43,200 is borrowing cost and balance will be your exchange fluctuation. So 43,200, the savings in interest cost, will treat it as exchange difference, and the balance amount, whatever is left over, that amount will be treated as exchange difference. That is 60,000 minus 43,200. So this is basically 16,800 will be treated as your exchange fluctuation. So here this computation is very, very important. Unrealized gain, you can ignore it. They have not tested so far. Right? Now that is about borrowing cost. So borrowing cost includes interest, anything that forms part of interest, your transaction cost and all, which are calculated using the effective interest method. Right? Now, as far as borrowing cost is concerned, what the standard says is, if you are incurring borrowing cost on a qualifying asset, then you need to capitalize the interest cost or the borrowing cost. Now, what is a qualifying asset? Which takes substantial period of time, generally a period of greater than 12 months. This is an assumption. Question may say less than 12 months, also it is a qualifying asset, then you have to do it accordingly. So any of the following assets may be qualifying asset: inventories, plants, power generation facilities, intangible assets, investment properties, bearer plants. Now inventories, unless it, things like let's say construction business or wine industry, where inventory takes a substantial period of time to get ready for use. Period of 12 months or more might be considered as substantial. Exclusions from qualifying assets: financial assets and inventories that are manufactured or otherwise produced over a short period of time, something which can get ready over a short period of time, or assets that are ready for their intended use or sale when acquired are not qualifying asset. So here question generally will tell you which is a qualifying asset, or you have to apply your mind. If I am buying a truck, that truck is not a qualifying asset because truck is ready to use, or it will be ready to use in a short period of time, right? Now, the core principle of this standard is borrowing cost. Now, borrowing cost here means your interest expense, then including your exchange differences, which are considered to be borrowing cost. Okay, which are directly attributable to the acquisition, construction, or production of a qualifying asset, are capitalized as a part of the cost of qualifying asset. Which principle? Same. You have to get future economic benefit, and cost can be measured reliably. Other borrowing costs are recognized as an expense in the period in which they are incurred. Then, What is the borrowing cost eligible for capitalization? The borrowing cost that would have been avoided if the expenditure on the qualifying asset had not been made. So if I could have avoided the interest cost, if the qualifying asset was not there, means if the qualifying asset was not there, if the building construction did not happen, I would not have incurred the borrowing cost. In that case, we capitalize the borrowing cost. Now there are two types of borrowing cost. One is specific borrowing cost and another one is general borrowing cost. Specific borrowing cost is a borrowing which I have done for the specific asset. So the question will tell you, the entity borrowed rupees 5 lakhs for construction of a building. That is a specific borrowing. For specific borrowing cost, very simple principle, no need to break your head. Take the borrowings, multiply by the term of the loan, multiplied by the rate. Term of the loan divided by 12, divided by rate, this is your cost. Minus, if there are any temporary income, temporary investment income, you will deduct that and entire amount is capitalized. Now, a lot of time in the examination, borrowings happen 1 month before, expenditure happens from next month onwards. But if it is a specific borrowing, you will take it from the date of borrowing. Why? Because we have taken the borrowing for the purpose of the asset. It is a specific borrowing, we have taken the borrowing for the purpose of the asset. So the entire borrowing will be considered for the entire term of the loan multiplied by the rate. So what about that ideal period? For that ideal period, we will have temporary investment income which we will reduce, right? So if the entity borrows funds specifically to obtain a qualifying asset, they are specific borrowings. Specific borrowings cost eligible for capitalization would be the actual borrowing cost incurred during the period less any investment income on temporary investment of this borrowing. Okay. So if you have obtained borrowed funds before some or all of the funds are used for expenditure, then the funds are temporarily invested pending their expenditure. So whatever income you get here, that you will reduce and balance is the borrowing cost eligible for capitalization. Then what are general borrowing cost? All the borrowings which are not specific borrowings are general borrowing cost. Now for the general borrowing cost, we calculate something called as capitalization rate. Now how do we calculate the capitalization rate? You take the total borrowing cost on the general borrowings, total outstanding general borrowings of the entity during the period. This will give you the capitalization rate. Now sometimes they may give you borrowings on different date. So you borrowed something on, let us say, 1st of April. Then some other borrowings happen on 1st of August. Like this, you can have general borrowings on different dates, right? Now for that case, what you will do is, from 1st of April, how many months outstanding? 12 months outstanding. Then from 1st of August, how many months outstanding? August, September, October, November, December, January, February, March, 8 months outstanding. So you will calculate the product. So you will have loan amount, 1 lakh into 12, you have 12 lakhs. 1 lakh into 8, you will have 8 lakhs. So total 1 month borrowing or total borrowing equivalent for 1 month is 20. Then you will calculate what is the total interest, and this interest divided by the total amount borrowed will give you the rate for 1 month. That you will annualize. Meaning to say, for example, you will calculate interest for the first borrowings and second borrowing. You will find the total of interest. Total interest divided by total product into 100. This will give you 1 month interest rate. That you will multiply by 12 to get annual rate, and that annual rate you will apply to calculate what is the borrowing cost to be capitalized. Please practice a question on this. This is the type of question which is generally tested in the examination. Then amount of borrowing cost that is capitalized shall not exceed the amount of borrowing cost incurred during that period. So maximum amount you can capitalize is the maximum borrowing cost that has been incurred during the period. Capitalization rate is calculated considering all general borrowings outstanding during the financial year and not necessarily during the construction period. So generally for the entire financial year, what is the borrowing outstanding? Considering that, you will calculate the capitalization rate. Then the expenditure to which the capitalization rate is applied means after you have calculated the capitalization rate, to which expenditure shall we apply this particular rate? Amount of expenditure on a qualifying asset include those expenditure that have resulted in either payment of cash, transfer of asset, or assumption of interest bearing liabilities. Meaning to say, either you have made the payment or made the cash payment, then to that expenditure you will apply the rate and calculate the borrowing cost, or you have transferred any other asset. Basically you have transferred some resources, or you have assumed interest bearing liabilities. You have assumed liabilities means you have incurred liabilities on which there is an interest component. You have to pay interest on that. If any of these three considerations have passed on, from that date you will apply the percentage rate and calculate the borrowing cost. When do we commence the capitalization of borrowing cost? Commencement of capitalization starts from the date when the entity first meets all of the following conditions: incurs expenditure for the asset, incurs borrowing cost, undertakes activities necessary to prepare the asset for its intended use or sale. Now here generally what you have to understand is the work must be going on, that's the first thing, and you have incurred the borrowing cost and you have incurred the expenditure on asset. Now some of you may be having a doubt, so during that idle period when we are not using funds, when we have done a specific borrowing, why do we consider this part also? The thing is, for this part, whatever earnings we have made, we are deducting it. So indirectly, we are negating the effect of that idle period. So that is one thing you have to keep in mind. Condition, incur expenditure. Incurring expenditure means either pay cash or transfer asset or assumption of interest bearing liabilities. Incur borrowing cost, you are incurring, either you are accruing or paying, and you are carrying out the activities. Now sometimes there could be periods where no production or development happens that changes the asset conditions. In that case, you will exclude that period. Sometimes there may be abnormal stoppages, there may be water overflowing over a bridge. Because of excess water, you are not able to carry on the construction. So if it is abnormal, unanticipated, during which the asset development is paused, you will exclude that period for capitalization. When do we stop capitalization? During the extended period in which active development of a qualifying asset is suspended. Means the period during which no work is happening, no active work is happening, some unplanned breaks have happened, that period you will exclude. Capitalization of borrowing cost is not suspended when temporary delay is necessary part of the process of getting an asset ready for its intended use. Now for example, building construction. After you put one slab, you have to maybe wait for 10 to 15 days. Okay, you cannot say for the 10 to 15 days period I will stop capitalization. You will continue to capitalize. Normal process, breaks and all, you will continue to capitalize. When do you stop capitalization? When substantially all the activities necessary to prepare qualifying asset for its intended use or sale are complete. So substantially all the activities are completed. Just ribbon cutting is pending, some small screw fitting is pending, major activities are completed, then you will stop capitalization of borrowing cost. The normal expenditure capitalization will continue, borrowing capitalization will be stopped. An asset is normally ready for its intended use when the physical construction of the asset is complete, even though routine administrative work may continue. So some routine activities may be continued, but once the asset is substantially ready, you will stop the capitalization of borrowing cost. If you have construction of qualifying asset which is completed in parts, then you have to see whether each part can be independently used. If one part can be independently used, once that part is completed, stop the capitalization of borrowing cost on that part. Now as far as this is concerned, so for basic calculations, refer to this illustration 3, illustration 4, illustration 5. Okay, this will help you to calculate the weighted average cost that has to be considered for capitalization. This question number 11 is also a good one which you can practice. Now let's move on to the next standard, IndAS 20. IndAS 20 deals with government grants and disclosure of government assistance. This is more important from examination point of view. Now the difference between government grant and government assistance is, in case of government grant, there is a transfer of resources. It can be monetary, it can be non-monetary, but there is a transfer of resources. Now who is a government? Government can be central government, state government, government agencies, or local, national, international government bodies. So municipal corporation, any body, local, national, international, state government, central government can be a government. Government grants are assistance by government in the form of transfer of resources, this is important, to an entity in return for past or future compliance with conditions. So there is a transfer of resources, monetary or non-monetary. There is a condition to be fulfilled either in the past or in the future. That is what is a government grant. Now important exclusions from IndAS 20, one is government participation in the ownership of the entity. So if the government invests in, let us say, shares of a company, that is not considered to be government grant. Then government grant, that will be covered by IndAS 41 agriculture. On this there was an MCQ in May 24 as well. So if it is covered by IndAS 41 on agriculture, you will take it as per IndAS 41 and not as per IndAS 20. Income tax related benefits are also not covered as a part of government grants. This part you can just ignore. Sales tax exemption, expert advisory commission have opined that sales tax, now GST, foregone by the government will be covered under IndAS 20. Now though this looks similar to income tax, they have specifically said that if sales tax exemption have been given, then that is not covered, that is covered under IndAS 20. Now what are the types of government grant? Grant can be related to an asset. Here you have two options, one is reduce from the cost of asset, or second is set up a deferred grant account. Then grant can be related to income. Related to income means for revenue items like so achievement of certain expenditure, incurring of certain expenditure, hiring of certain employees. For that, if government grant is given, then that is grant related to income. When can we recognize government grant? First, there is a reasonable assurance that the entity will comply with the conditions. The assurance should be reasonable and the entity will comply with the conditions and that the grant will be received. So, you have to have assurance for complying with the conditions and grant being received. Receipt of grant is not a conclusive evidence that the conditions to the grant have been or will be fulfilled. Just because we have received the grant, we cannot recognize it in our books of accounts. Now, as far as accounting of grant is concerned, we will follow the income approach. We will not treat the grant as capital receipt under equity. Means, we will not show it under capital reserve like we do in accounting standard 12. So, there is a distinction here. We will follow the income approach. Now, coming to different ways of accounting for different types of asset, if it is grant related to asset, you can either follow a deferred income method or you can reduce it from the cost of asset. So, what happens is, if you follow deferred income method, asset is recognized at original cost of here, let us say 30 lakhs, grant is credited to deferred government grant account. It is credited to deferred government grant account and every year you charge depreciation on original cost. So, 30 lakhs by 5 is 6 lakhs. From this government grant deferred income account, you will transfer to P&L amount in the ratio of depreciation. Now, if the depreciation is SLM basis, every year the transfer also will be same. If depreciation is WDV basis, in that proportion you will transfer from deferred government grant account to the P&L account. If it is following the approach of reduction from the cost, then you will debit it to asset account, credit to bank account for the purchase. Grant will also be credited to asset account and depreciation will be charged on 30 lakhs minus 10 lakhs, that is 20 by 5, which is 4 lakhs, right. Net impact will be 4 lakhs in both the cases. If it is non-depreciable asset, because there is no depreciation, how will we transfer from deferred grant account to the P&L account? You will follow some other systematic basis. Maybe the other expenditure incurred to fulfill the condition of the grant. Okay, so that can be a basis to transfer from deferred grant account to the P&L account. If it is a grant related to income, then of course you will set up a deferred grant account. Then from this deferred grant account, periodically you will transfer to P&L. Now, how do we present it in the P&L? One is you can show it at gross values, means expense also at the actual amount and grant also on the gross amount, or you can show it on a net basis. That means expenses minus grant, you can show it as a net amount. Then very important, government grants cannot be recognized on receipt basis, so that cannot be done. If you receive non-monetary grant, then how is the accounting? For non-monetary grant, you can either account for it at fair value, that is, let us say the government gave land for free. So, fair value is 10 crores. So, you will take 10 crores as the value of land debit 10 crores and deferred grant account 10 crores, or you can do it at nominal value. Land you can show it at, let us say 100 rupees and deferred grant account also you can show it at 100 rupees. Both these ways are possible. If you follow the fair value, both the asset and the grant is shown at fair value. If you follow the nominal value, the asset and grant, both of them are shown at nominal value. Then if there are grant related to loans, so there can be two types of grant related to loans. One is forgivable loans. Forgivable loans means the government will say you don't repay the loan. That means whatever is the grant received, that itself becomes the grant value. For example, government gave me 10 lakhs of loan. Government said 5 lakhs you don't need to repay. So that 5 lakhs becomes my grant. Or if there is a concessional rate of loan. Now this we understand in IndAS 109 as well. If there is concessional rate of loan, then you will discount the cash flows at market rate. This will be your loan amount, right. So, for example, the government has given you 1 lakh of loan. By discounting this at the market rate, the loan value came to 4 lakhs. So, the balance 6 lakhs will be your grant value. Okay, this enough number of questions are there in terms of employees, investment in the subsidiary and all of that in IndAS 109. So, this also follows the same principle, right. Then repayment of grant. Now, what is this repayment of grant? If the conditions are not fulfilled, the government may say, please pay back the grant. Now, how do you do that? It depends on what was the original entry. If the original entry was reduction from asset, refund of grant will be added to the asset. For example, if you had said on receipt of grant, you had said bank to asset. Now, if there is a refund, you will say asset to bank. Or originally you said bank to deferred grant. Refund will also be deferred grant to bank. when there is a refund. Sir, what if there is no balance left? Now the next question is, if there is no balance, say for example we have received a grant of 100, okay, and for some reason grant to be refunded is 80, but in the balance in deferred grant account we have only 60. So what do we do with the balance? The difference of 20 will be taken to P&L. So use the balance in deferred grant account and balance will be debited to the P&L for the rest of the repayment. If a government grant becomes repayable, it is treated as change in estimate as per IndAS 8. Okay, discloses things you can quickly go through. Then comes IndAS 36, very important because of computations also involved in the particular standard, right? Now what is impairment? Impairment basically means there is a loss. Okay, I have an asset, I don't expect that I will recover the value of that asset, and hence there is an impairment. Now when it comes to impairment, very important, a quick recap of what is not covered under IndAS 36. A lot of times students get confused as to when to apply IndAS 36, when to apply other standards. Inventories, IndAS 2, because here you are anyways valuing it at lower of cost and NRV. Contract assets and assets arising from cost to obtain or fulfill a contract as per IndAS 115. Deferred tax asset, IndAS 12, there is no question of impairment, because if there is a deferred tax asset which you don't realize, you will bring down the value of the deferred tax asset as per the principles of IndAS 12. Assets arising from employee benefits, you will do it as per IndAS 19. Financial assets, IndAS 109. Biological assets related to agricultural activity, IndAS 41. 104 is anyways not applicable. Non-current asset classified as held for sale, IndAS 105. Here also it is fair value less cost to sell, but you don't have value of use concept. Financial assets, IndAS 109, it's just a repetition. Now the most important thing, what is impairment loss? First you will calculate the carrying amount. How do we calculate the carrying amount? You will apply the principles of IndAS 16, IndAS 38, IndAS 40 respective standard. You will apply the principles and arrive at the carrying amount. Means till the date, if depreciation has to be charged, you will charge the depreciation, only then you will bring that asset in IndAS 36. So first tick off IndAS 16, IndAS 38, IndAS 40, then you come to IndAS 36. Okay. So whatever is the cost, revalued amount less accumulated depreciation and amortization, that will be your carrying amount. Then you will calculate the recoverable amount. What is recoverable amount? It is higher of fair value less cost to dispose or value in use. Higher of these two will be the recoverable amount, and if the recoverable amount is less than the carrying amount, so recoverable amount, say for example fair value is 100, value in use is 120, which is higher 120. So recoverable amount is 120. Carrying amount is, let us say 80. Is this impaired? It is not impaired. Carrying amount is 180. Then there is an impairment loss of 60. Okay. So that is what the meaning of impairment. Now, when do we calculate impairment? At the end of each reporting period, we have to see if there is any indication that the asset might have been impaired. So first you will check the indication. If any indication exists, then you will estimate the recoverable amount of that asset. You will not do that. I will first estimate the recoverable amount and then I will directly do the impairment. First you have to see the condition. Okay, then there are some items which are required to be tested for impairment at least annually, means irrespective of whether conditions are there or not, you have to test for impairment annually. Intangible assets with indefinite useful life, indefinite means we are not able to determine. Intangible assets not yet available for use, and goodwill acquired in business combination as per IndAS 103. For these categories, whether or not there are indication, every year you will test for impairment. Now when it comes to indication of impairment, there can be external source, internal source, and specific discussion for investment in subsidiary, joint venture or associate. Now what is external source? So external means something external to the entity and the asset. So there could be significant decline in market value. If the market value is declined, then you will feel that yes, the fair value less cost of disposal will also be reduced. Significant changes in technology, new technologies have come in, because of which the asset is no longer useful. Increase in market interest rate or rate of returns. Rate increases, value decreases. Carrying amount of net asset is greater than the market capitalization of the entity. So market capitalization of the entity is, let us say, 100 crores. Book value is 150 crores. So the market is putting a value of 100 crores, maybe for some problem. Okay, so in that case also there could be an indication of impairment. After this is done, we have to calculate the recoverable amount. Internal sources, physical damage, significant changes in expected use, evidence available from internal reporting. So management and all are discussing that yes, this asset has become useless. So that also can be an indication of impairment. Then as far as investment in subsidiary, joint venture and associates are concerned, if the investor recognizes a dividend from the investment and evidence is available that carrying amount of investment is greater than the carrying amount of investee's net asset in the consolidated financial statement, or dividend is greater than total comprehensive income of the investee. So basically what it means is the amount of investment that I am showing is greater than the carrying amount of investee's net asset. So in the consolidated financial statement, the net assets that I am showing, that is lower. In the standalone financial statements, my investment value is much higher. Now what could be the reason for this? The reason is investment, let us say I have recorded at cost. Dividend I have recorded in P&L. The subsidiary has already paid all the dividend and I have recognized all of this in P&L. So I am showing the investment, let us say at 1000, subsidiary has net assets of only 100. So then there could be an indication of impairment. Here impairment means I will not be able to recover this 1000, right? Same way, if the dividend is greater than the total comprehensive income of the investee, there could be a cases of impairment or indications of impairment, right? This is more important from your MCQ point of view rather than calculations point of view. Now moving on to the next concept of cash generating unit. Now what is this cash generating unit? When do we use this cash generating unit? Generally what happens is, if there is an asset which cannot independently generate cash flows, we may not be able to determine the recoverable amount or value in use. In that case, what we do is, we take a group of assets and see for the group of assets what is the cash that can be generated, what is the value in use for that cash generating unit. So that is what is called a CGU, where you have a group of assets. Okay. When you cannot determine for a single asset, you aggregate that asset and you will take that group of asset which can generate cash flows, and at that level you will measure the impairment. The lowest aggregation of asset that can generate largely independent cash inflows which are monitored for internal management purpose, that becomes the CGU. So if for me, for example, if I have a building, that building alone cannot generate cash flows, but that building has other machineries, has other assets, all put together that can generate cash flows, becomes my CGU. Then fair value less cost to dispose. Fair value is the price that will be received to sell an asset or paid to transfer a liability in an ordinary transaction. So that is basically the exit price, and cost of disposal is incremental cost directly attributable to the disposal of an asset or a CGU. Now in examination, in most of the cases, you will get a question based on CGU and not on a single asset. If you get on a single asset also, it is much more simpler. You will not consider finance cost and income tax expense in the cost of disposals. What is value in use? Value in use is the present value of future cash flows expected to be derived from the asset or cash generating unit. Now, few things that you have to be careful about calculating the expected future cash flows. You have to see that the evidence is reasonable and supportive. Then you will give higher weightage to external evidence. Then you can use financial budget and forecast that have been approved by the management. Things that you have to keep in mind is, forecast should not be done based on from future restructuring or enhancing asset performance. Now this is very critical, because a lot of times students get confused here. If there is a future restructuring which is anticipated, and because of that I will have a higher cash flow, I should not consider that. If there is a future restructuring to which the entity has committed already, then that can be considered for calculations of cash flows. So if you have committed to the future restructuring, you will include that. If you are not yet committed, you are just thinking, then you will not consider that for calculation of cash flows. Cash flows projections beyond the budget period should be estimated by using a steady declining zero negative growth rate. So either a steady growth rate or a declining growth rate. It should not be exponentially higher growth rate. And maximum period covered should be 5 years unless a longer period is justified. Growth rate used should not exceed the long term average growth rate in the industry. So again, when you are forecasting the growth, it should not be higher than the long term average growth. This is important. What all will you include and exclude from the cash flows? Include cash flows from the use of the asset, yes. Net cash flows to be received at the time of disposal. So one is when you continuously use it, second is when you actually dispose it. Then day-to-day servicing of the asset, future overheads that can be attributed directly or allocated on a reasonable basis to the use of asset. So day-to-day servicing of the asset, day-to-day repairs and maintenance of the asset. Appropriate apportionment of corporate overheads. So very carefully, if at all something is attributable to that particular asset or CGU, you will allocate that. What will you exclude? Cash inflow from assets that generate cash flows that are largely independent from the asset under review. For example, receivable. So if there is an account receivable, already there is a receivable, from that you will get the money anyways. That you will not include in the cash flow of the asset. Cash outflows that relate to obligations that have been recognized as liability. Already you have recognized a liability. For that you will anyways have a cash outflow. That you will not include in the cash flow of the particular asset. Cash flows from entities plans which are not yet committed, this is very important. Restructuring plans which are not committed, for that neither you will consider the outflow nor you will consider the inflow. Any internal charges incurred by the CGU for using corporate assets, that you will not include. Cash flows that are expected to arise from improving in or enhancing the assets performance, that you will not include. Cash flows from financing and income tax receipts and payments. So this you have to remember what to include and what not to include. If there are foreign currency cash flows, they are estimated in the currency in which they will be generated and discounted using the rate appropriate for that currency. So estimated in the foreign currency, discount rate for that currency will be used. Discount rate, you will use the pre-tax rate. Then sometimes there may be inflation angles also which would be given as a part of the question. Now if you have factored in inflation in the cash flows, the discount rate also should be adjusted or should also reflect that yes, the inflation has been factored in, meaning to say you will use a nominal rate. If the inflation factor is not included, then you will use the real rate. Now very important, how do you recognize and measure the impairment loss? Now as far as impairment loss are concerned, if you are following the revaluation model, then you will treat, if there is a revaluation surplus, you will recognize in the OCI, you will debit it to OCI, and if balance is not sufficient for that specific asset, you will recognize in P&L. So what does that mean? Let us say 100 is the revaluation surplus, impairment loss is 150. So 100 will be debited to revaluation surplus, balance 50 will be debited to P&L. If you are following the cost model, you will recognize immediately in the statement of P&L. Then if there is an impairment loss which is greater than the carrying amount of the asset, you will recognize a liability, because if at all you have to incur a liability to dispose of that asset, then that will be recognized separately. Once impairment has been charged, depreciation shall be calculated on the revised carrying amount. So once impairment has been charged, so you will take the cost minus depreciation minus impairment. On this carrying amount, you will charge the revised depreciation. Now when it comes to a CGU, for cash generating unit, you have to determine the carrying amount because it is not a single asset. So here what you will take is, for example, there is inventory, you will value it as per IndAS 2 and then you will add it to the value of the CGU. Like this, for all the assets, you will take the carrying amount of those assets that can be attributed directly or allocated on a reasonable and consistent basis to the CGU. Now what will you exclude? Carrying amount of any recognized liability unless the recoverable amount of the cash generating unit cannot be determined without consideration of the liability. So any liability is there that you will exclude unless you cannot determine the recoverable amount without considering this liability. Now sometimes what happens is, when you sell off an asset or when you dispose of a CGU, the buyer is required to assume the liability. For example, if there is a property, plant and equipment. Now for the property, plant and equipment, there is a decommissioning liability. Now the buyer has to take over the decommissioning liability. In that case, what you will do is, you will adjust the decommissioning liability in both value in use, also in the carrying amount, so that you compare it properly. Now when there is a impairment loss of CGU, what you will do is, first you will adjust against goodwill, second you will adjust against remaining asset in ratio of carrying amount. Okay, so whatever is goodwill, that will be first written off. After that, in the remaining assets in the ratio of their carrying amount. Now here one thing that you have to keep in mind is, let us say I have already an inventory which is valued as per IndAS 2. Now this is already recorded at NRV. Now as far as inventory is concerned, I cannot bring it down below the NRV. I have to keep it as per its net realizable value only. So while allocating impairment, what you have to check is, after impairment, the value should not be less than the individual assets recoverable amount. Okay, that is one thing you have to keep in mind, right? So carrying amount of individual asset within the CGU shall not be reduced below the highest of fair value less cost to sell, value in use. What is the highest of these two? Basically the recoverable amount. So if, let us say, the recoverable amount of a particular asset is 100, okay, carrying amount is, let us say, 120, impairment loss allocable is 30. So 120 minus 30 becomes 90, but you cannot show it below 100, you have to show it at 100 only, because individually that asset you expect to realize 100 from that asset. So it should not be below fair value less cost to sell, it should not be below value in use, and it should not be negative. Of course, it cannot be below 0, right? Then another important area is corporate assets. Corporate assets are assets like head office, a centralized head office which is which has to be allocated to multiple cash generating units, right? Now, as far as corporate assets are concerned, they don't independently generate cash. So, generally you have to add it to some or the other CGUs. Now, what you have to do is, when you have to allocate corporate assets to CGU for impairment, first you have to see, can we allocate the corporate assets to CGU on a reasonable and consistent basis? Can we allocate? If the answer is yes, allocate the corporate assets to the CGU and do the impairment testing. Whatever loss comes, first you allocate to goodwill and then remaining to other assets on a pro rata basis. Very simple. Now, if you cannot allocate the corporate asset to a CGU, then what you will do is, you will ignore the corporate asset and you will take the amount of CGU without the corporate asset and compare it with the recoverable amount, and you will do the impairment calculation and allocation normally. Then you will do for one CGU, you will do for another CGU, like this you will keep on doing till the time you can combine this CGU and add corporate asset to this. After that, what you will do? You will take all of these and repeat the impairment testing exercise. So, without corporate asset, you will first calculate impairment, allocate the impairment to goodwill and other assets other than corporate asset. From the level from which you can add corporate asset, you will add corporate asset and then do the impairment testing. This is also important, reversal of impairment loss. When can the losses of impairment be reversed? You can reverse when there is an indication that the impairment losses recognized in the previous years may be decreased or they don't exist anymore. So, if the reversal indicators are there, then you can do the reversal of impairment. Very important, goodwill impairment cannot be reversed at all. So, once you have recognized impairment on goodwill, you will not reverse impairment on the goodwill again. Impairment loss recognized in prior periods for an asset shall be reversed only if there is a change in estimate used to determine the recoverable amount. Means the estimate has to change. So, what you have to keep in mind is the estimates that you have used. So, what are the estimates? Estimates for, let us say, fair value less cost to sell or value in use has changed. The amount or timing of the future cash flows, the discount rate has changed. Estimate of components of fair value has changed. If these estimates have changed, only then there can be a reversal. Sometimes what happens is, the value in use may become greater than the carrying amount simply because the present value of future cash flow increases as they become closer. As and when you reach to the closer of the expiry, the value in use may increase because of unwinding of discount. Does that mean reversal of impairment? It does not mean reversal of impairment. So, you have to look at indicators both external and internal. These are nothing but exactly opposite of the impairment indicators. Now, very important, this treatment. Reversal of impairment in case of individual asset. If there is no revaluation done, means you are following the cost model, you will increase the value of asset and you will credit impairment loss, or you can say you can create an impairment gain. This will be recognized in P&L. So, very simple, add it to the asset. Now, two things you have to keep in mind. First, this impairment loss reversal shall not exceed impairment loss provided earlier. So, it should not be greater than the impairment loss that you have provided earlier. That is the first thing. Second thing is, this asset amount, the carrying amount after reversal. So, the carrying amount has increased. That carrying amount after reversal shall not exceed carrying amount before impairment minus depreciation on original carrying amount before impairment. Basically, what it means is, if for example, carrying amount before impairment was 1000, depreciation on this for 3 years, assuming 10 years remaining life, is 300, it would have been 700. Now, on this 1000, there was an impairment of, let us say, 400. So, value became 600. 3 years depreciation is 180. So, you have a balance of 420. Now, if the recoverable amount is 800, 800 minus 420, 380 is the reversal. Can I reverse 380? By looking at this 400, you may say, yes, you can reverse 380, but the value after reversal cannot be greater than 700. So, I have to restrict this 800 to 700 only. The increased carrying amount of the asset shall not exceed the carrying amount that would have been determined had no impairment loss been recognized. So, basically what it says is, ignore the impairment, calculate the carrying amount without impairment. After reversal, the carrying amount cannot be greater than the carrying amount without impairment. So if impairment was not there, you will arrive at a particular value. This is 700. After the reversal, the carrying amount cannot be greater than 700. Okay. And maximum loss shall be impairment loss previously recognized. If revaluation was done in the prior periods, so if it was under the revaluation model, then the revalued asset shall be treated as a revaluation increase. It will be treated as a revaluation increase. Now, if it is a revaluation increase, what is the treatment? Because we have charged impairment loss earlier, and if you had recognized that impairment loss in P&L, please remember, for revaluation surplus cases, impairment loss is first recognized against the revaluation surplus, and then balance is charged to P&L. So whatever was recognized in P&L, you will reverse in the P&L, and balance will be added to the revaluation surplus. Very important for you to keep in mind. A reversal in the impairment loss for a CGU should be allocated to all assets except goodwill on pro rata basis of the carrying amount. Again, the increase in carrying amount of individual assets shall not be increased more than the recoverable amount or actual carrying amount as if impairment was not recognized, whichever is lower. So what it means is, if recoverable amount is 1000, carrying amount if impairment loss was not charged is 800, you will restrict that reversal to 800 only, means you will bring back the asset value only to the extent of 800. Then this is a important concept for goodwill testing when it comes to IndAS 103-110 concepts. Now NCI can be valued using two methods. The simplest way to remember is proportionate share in net asset method and fair value method. This is called part goodwill, proportionate share part goodwill. Fair value method is full goodwill. Full goodwill is there, the calculation does not change. Normally whatever you do the calculation, same thing will happen. If it is part goodwill, you will gross up. So for example, out of 100%, parent has 80%, NCI has 20%. 80% goodwill is, let us say, just for example, 200. If it is proportionate share in net asset, then we will see how much should be 100% goodwill, that is 200 into 100 divided by 80. This goodwill you will consider for calculation of the carrying amount. This goodwill you will consider for calculation of carrying amount, remaining all will remain the same. Okay. Now when it comes to impairment, goodwill impairment, so 200 divided by 80 multiplied by 100 is 250. When you write off goodwill, again you will write off only 80% of the impairment related to that goodwill, because full goodwill is not recognized in the books. Okay. So this you will understand when we do questions on 110. There is a very good question in that chapter which you can revise. So that is it about IndAS 36 on impairment. Let's move on to the next one, which is IndAS 105, that deals with non-current assets held for sale and discontinued operation. So it has to be a non-current asset which is held for sale, or it has to be a part of disposal group, and this standard also covers discontinued operation. As far as non-current assets held for sale is concerned, you have to consider what is the carrying amount, you have to consider what is fair value less cost to sell. Whatever is lower, whichever is the lower amount, you will measure non-current assets held for sale at this particular amount. As far as non-current assets held for sale are considered, once they have been classified as held for sale, subsequent depreciation will not be charged. The assets which are outside the scope: deferred tax assets, employee benefits assets, financial assets, non-current assets related to agricultural activities, and of course IndAS 104 is not applicable. Now this is important more from an MCQ point of view. Quick difference between impairment and non-current assets held for sale. Impairment is when the asset is still being used and depreciation is charged, whereas here it is only when the usage is stopped and depreciation is not charged. Whereas the treatment of losses is same as what you do in case of IndAS 36. So whatever loss arises when you classify a non-current asset held for sale, that will be treated in the same way as if it was an impairment. When should we classify a non-current asset as held for sale? An entity is required to classify a non-current asset or a disposal group. Disposal group is a group of assets as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through use. So if the objective is to recover the money by selling the asset, then you say it is a non-current asset held for sale. As long as future economic benefits are received from the usage of asset, you cannot classify it as held for sale. Now, two important conditions: it must be saleable in the present condition and sale must be highly probable. Okay, it's not that I am thinking to sell, I am saying sale must be highly probable, more than 50% probability. If the asset is not saleable in the present condition, that is if you need repair or something, then it cannot be classified as held for sale. You repair it and then you classify it as held for sale. Few conditions, again important from MCQ point of view. The appropriate level of management must be committed. So, the management must be committed to a plan of sale. Active engagement to find the buyer. So, you should have started searching for the buyer. Should be actively marketed. Not only you are searching for the buyer, you are also marketing the non-current asset. Sale is expected to completed within 1 year from date of classification, and significant changes or withdrawal is unlikely. So, the time period that you have to remember, 1 year from the date of classification. Then sometimes what happens is, there may be circumstances which may extend the period to complete the sale beyond 1 year. Normally we said it has to be 1 year, but there could be circumstances that sale may happen after 1 year. Now, in such cases what you have to see is, the delay should be caused by circumstances beyond the entity's control, means the entity does not have control and the entity is still committed to sell. If these two conditions are satisfied, you can still classify it as held for sale. Then, if there is an asset which is acquired for subsequent disposal, means you have purchased an asset, the objective is to dispose it up subsequently, immediately after you have acquired that asset, then you will classify that as held for sale as at the acquisition date itself, if the 1 year requirement is met and it is highly probable that any other condition that is not met at the time of acquisition will be met within a short period. So, you buy an asset with an intention to resell it immediately, a non-current asset, then you will classify it as held for sale as at the acquisition date. Now, coming to the most important part, the measurement principle. Non-current assets held for sale are measured at lower of carrying amount and fair value less cost to sell. Now, here value in use is not applicable. So, before you bring it to IndAS 105, you will again measure the carrying amount as per the respective standards. Even if impairment is applicable, you will measure impairment first and then bring that asset to IndAS 105. Then, when there is a disposal group, means a group of assets, scoped in assets are measured as per this standard, that is fair value less cost to sell or your carrying amount, whichever is lower. Other assets, for example, the disposal group has inventory, you will measure that as per IndAS 2 as per the respective standard. Then all put together you will see what is the final amount that you will be showing in the balance sheet. Now, if there is an inventory which is as per IndAS 2, then what will you do? You will measure it at lower of cost or net realizable value. Now, net realizable value also is similar to your fair value less cost to sell, right? Then you will measure it as per respective standard and then see what is the final amount to be shown in the balance sheet. Now, recognition of impairment losses and reversal. Now, first, if the carrying amount is let us say 100, fair value less cost to sell is let us say 80, then there is a loss of 20. This 20 will be treated as an impairment loss and it will be recognized in the P&L. Now, subsequently, if there is a gain, if there is a reversal that is happening, then this 20, to the extent of that 20 what you have charged earlier, or if there has been impairment reversal according to IndAS 36, as per that standard, whatever has been the reversal in value, to the extent of previously recognized impairment loss, you can say that yes, to that extent you can recognize the gain. Okay, where will you recognize the gain? That gain will be recognized in P&L. The impairment loss or any subsequent gain recognized for a disposal group shall be allocated. So, if there is a disposal group, you will recognize the impairment loss in the ratio first to goodwill and next to other assets in the ratio of their carrying amounts, right? Reversal of impairment is not allowed on goodwill, and if there are any losses which are not recognized at the time of initial classification as held for sale, when you finally sell the asset, you will recognize the gain or loss. Then, if there is a subsequent reclassification, means we have classified it as held for sale. Now, again we want to bring it back to PPE, then same principles what we learned in IndAS 36 will be applicable. You cannot restate it at a value greater than the amount which would have been arrived at if depreciation would have been charged. So, this we have seen in IndAS 36 also. You will remeasure it at lower of carrying amount before classification after adjusting for depreciation amortization which would have been provided and recoverable amount whichever is lower. So, lower of these two amount is at which you will measure the reclassification. Then we have another aspect which is discontinued operation. Discontinued operation is a component of an entity which is either disposed of or is classified as held for sale. This is called to be a discontinued operation. So, this discontinued operation which is a component has to represent a major line of business or geographical area of operation and is a part of single coordinated plan to dispose of a separate major line of business or geographic area of operation. Now, this is more of a disclosures part of IndAS 105 And here what you need to do is, if you are selling off a significant component, then that has to be classified as a discontinued operation. Now when we say discontinued operation, you will have a separate line item in the statement of P&L showing the loss or profit from the discontinued operation. Now here one thing you have to keep in mind is, if I am closing 1 out of 200 branches, closing of one branch is not a significant component, and hence that will not be a discontinued operation. But if I am exiting a full geographic area, if I am exiting from, let's say, India, then it is a significant component and it will be classified as a discontinued operation. It also includes a subsidiary acquired exclusively with a view to resale. If I bought a subsidiary and I will subsequently resell it, the objective is to resell it, this will also be called as a discontinued operation. Generally, a CGU or a group of CGU is that component. If it is significant, that will be classified as held for sale. Now, as far as discontinued operation is concerned, what you need to present is, you have to present the profit or loss from the discontinuing operation and tax expenses of that as separate line items. Okay, as separate line items you have to present it, and for the previous period also you have to do the reclassification. You have to present it separately, whatever is attributable to the discontinued operation, the profit or loss before tax, tax expense, and profit or loss after tax. Now sometimes what happens is, only this amount is shown in the face of the P&L, these two items are given as a part of the notes. In your examination you can do it either ways. Now as far as discontinued operation is concerned, if it is disposed of, profit or loss on sale is also presented in the section called profit or loss from discontinuing operation. If it is held for sale, then this loss on classification as held for sale, this loss is presented as loss from discontinued operation. Now discontinued operation being a disclosure standard, you have to disclose separately in the notes revenue, expenses, pre-tax profit, gain or loss on remeasurement and related tax expenses. So all of this has to be disclosed separately. EPS of discontinued operation shall also be disclosed separately as per IndAS 33 calculation. As I told you earlier, if the amounts of discontinued operations are presented separately, comparative figures are also represented. Okay, so that is as far as IndAS 105 is concerned. Now moving on to the next standard, very important standard, IndAS 116 on leases. Out of every 5 attempts, in 3 to 4 attempts we get a question from leases. Okay, so that is there. Now what is a lease? Lease is a contract or a part of contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Now here very important is this part of an identified asset. If the asset is identifiable separately, it has to be separately identified, and very importantly, the supplier or the vendor should not have any substantive substitution rights. A customer does not have a right to use an identified asset if the supplier has substantive substitution right to substitute that asset throughout the period of use. What does that mean? If the supplier can substitute that asset in order to make a gain, if they have some benefit, then in that case it cannot be called an identified asset. We have discussed enough examples in the class. A simple thing that you have to keep in mind is, if the vendor has substantive substitution, right? If the vendor can make profit or make a gain by substituting that asset, and they can do it at any point of time during the contract of the lease, then it is not an identified asset, and in that case it will not be a lease contract, and it will not be covered under IndAS 116. If the right to substitute arises after period of time or an occurrence of an event, for example, if you have taken a car and if the car breaks down, then it has to be replaced, then it is not SSR. SSR does not exist. And if the customer cannot determine whether or not the supplier has substantive substitution right, then we will say SSR does not exist. As per AS 19, we don't have such conditions for SSR. Now sometimes when we say identifiable asset, it could also mean identified storage capacity of a tank. Okay, so that also can become an identified asset. Now another aspect of the standard is to convey the right to control the use. So right to control means what? Right to control means the right to substantially obtain all the economic benefits from the use of an identified asset. It is very important. By using that identified asset, whatever benefits is available, if I can get all of that, then it is called, then we say that there is a right to control. Then the right to direct the use of the identified asset means what? I will decide how and for what purpose will that asset be used. Now when we say right to obtain substantially all of the economic benefits, so basically what did we say? Right to control arises when we have right to obtain substantially all of the economic benefits and right to direct. Economic benefits can be in the form of output, byproduct, and other benefits arising from using that asset. In some cases, supplier can have protective clauses. That does not mean that the benefit is not available to the customer, or the benefit is not available to the lessee. Now, as far as right to direct the use is concerned, how and for what purpose the asset is used, if the decision is with the customer, then the customer has the right to direct the use. If it is predetermined and the customer has right to operate without supplier interference, and if the customer has designed that asset, in these two cases also the right to direct the use is with the customer. Okay, protective clauses, the customer cannot use it for a specific purpose and all of that. If they are just protective clauses, then also we say that the right to direct the use is with the customer. Now, coming to some important terminologies that we need to remember. Inception and commencement of the lease. Inception is earlier date of lease agreement and commitment by the parties. So either the agreement or commitment to the parties, whichever is earlier, that is the inception date. And commencement date is the date on which the lessor makes an underlying asset available for use by the lessee, irrespective of whether the lessee has started operations or payments. So commencement date, lease commencement is the date on which the asset is made available to the lessee, that is the commencement date. The inception date is the date either when you have entered into the contract or you have agreed to the principal terms and conditions of the contract. Now, why is commencement date important? It is important to recognize the transactions, and lease period begins on the commencement date. Very important from MCQ point of view. Lease period begins from the date of commencement, and lease related transactions are recognized from the commencement date. As far as inception is concerned, we decide whether the contract contains a lease or not. So inception date is important for checking the classification. Okay, so that keep in mind. Now coming to the lease term. What is the lease term? Lease term is the non-cancelable period during which the contract is enforceable. The non-cancelable period of the lease is called the lease period. Now here please keep in mind, if there is any rent-free period, you will include that in the lease term. If there is any non-cancelable period, you will include that in the lease term. If there is an option to extend, if the lessee has an option to extend and it is certain or reasonably certain that it will be exercised, then you will include. If there is an option to terminate, you have to be reasonably certain that it will not be exercised. This will also be covered. So that makes the lease term. So rent-free period, non-cancelable, option to extend, periods covered by options to extend will be included if the lessee is certain, reasonably certain that it will be exercised. And if there is an option to terminate, the lessee is certain, reasonably certain that it will not be exercised, that makes the lease term. Lease term begins at the lease commencement date. If only the lessor has the right to terminate the lease, the period covered by the option is considered as non-cancelable. So we are looking at point of view of the lessee. If the when will the lessor cancel? The lessor will cancel only if they get some benefit. So if the lessor has the right to terminate, we will assume that the lessor will not terminate because vacating, getting a new tenant and all of that will actually become difficult. Lease term is aggregate of non-consecutive period if the lease is taken for non-continuous period. So if you are taking quarter basis, first quarter of every year, so then the lease term is total of all the periods covered by the lease. Options to extend and terminate should be assessed at the lease commencement. That is, when you are at the beginning of the lease, you will consider, or at the commencement of the lease, you will consider whether the option to extend or terminate will be exercised. Moving on to the part of revision in the lease term. Now, if there is an option to extend which was not included, initially there was an option to extend, we did not include because there was a reasonable certainty that the lessee will not exercise that option. Subsequently, if it is exercised or the event occurs which obliges the lessee to exercise, then now we will reassess the lease term. Similarly, if there is an option to terminate and we believe that the lessee will exercise, subsequently if the lessee does not exercise, then again we have to reassess. Or if there is an event that occurs which prevents the lessee to exercise, in that case also we will do the reassessment or revision of the lease term. Now coming to the most important part, lessee accounting. As far as lessee accounting is concerned, we have to compute the lease liability and right of use asset. What is lease liability? Present value of lease payments to be paid at the rate implicit in the lease or incremental borrowing cost if implicit rate is not known. Present value of lease payments to be paid, whatever is payable in the future. Whatever has been paid before commencement, that you will not consider. Only what is to be paid in the future. Now here students have a doubt. Sir, if it is payable at the beginning of each year, okay, should we include the first payment or not? If the payment is before the commencement, then you will not include. If the payment is after the commencement, so let us say you take the commencement of 1st of January and then you have paid the lease rental, then in that case you will include. Question will say that it has been made, or the payment has been made at before commencement, or it will be made at the beginning of each year. Okay, present value of these payments at which rate? Either rate implicit in the lease from the standpoint of view of lessor. If that rate is not known, then the incremental borrowing cost. If both are given, you will take the implicit rate in the lease. So this is lease liability. Now how do we get the right of use asset? To the lease liability, you will write lease payments made at or before the commencement. If any payments have been made before the commencement, you will add. If any lease incentives have been received, you will reduce. Initial direct cost will be added, and present value of dismantling and restoration cost will be added, right? All of these put together makes the right of use asset. So the first entry will be ROU asset debit to lease liability to bank if any other expenses have incurred to present value or provision for decommissioning and dismantling expenses. Then what are the lease payments that you should consider? Fixed lease payment. So the fixed lease payment as given in the contract, they would say 1,000 per month or 10,000 per month or per year. Generally exam questions are based on per year. So that you will consider as the fixed lease payment. Then we have something called as in substance fixed lease payment. Now this is something like we say 5% of sale, minimum 10,000. Okay. Now you have to pay 5% for sale. This is actually variable, but minimum 10,000 has to be paid. So this is actually we say in substance fixed. In substance fixed payments will be considered in determining the lease liability. So you will consider that. Lease incentives will be reduced. Variable payments dependent on index or a rate. So if there is a variable payment which is dependent on index or rate, that will be included in the lease payment. If it is a variable payment which is not dependent on index or rate, for example, dependent on output, production and all of that, that will not be included in the lease payment. Also, the future changes will not be considered when you initially recognize the lease liability, right? There is a question based on CPI index in the study material. You can have a look at it once before the examination, because a lot of students generally tend to get confused as to how to solve this in the examination, right? So whatever information is available right now, based on that you will measure. Subsequent changes will not be factored in or will not be considered to remeasure the asset and liability. So what about the subsequent changes then? Any excess or less payment in the subsequent period will be recognized in the P&L. Okay. Then residual value guaranteed by the lessee. If there is, very important, if there is anything which is guaranteed by the lessee. So we are saying lease liability. Lease liability means the lessee cannot escape. So if the residual value is guaranteed by the lessee, that will be considered as a part of lease payment. And if there is a purchase option, or if there is a option which says at the end of the period the lessee has an option to buy or the lessee will buy, that also will be considered. If you have to simply remember this, any obligation that the lessee has, that will be considered as a part of the lease payments. Now once it is done, once you have calculated the lease liability and right of use asset, subsequent measurement for as far as right of use asset is concerned, take simple thing like what is the principle that we followed in IndAS 16, same principles you will continue to apply. Okay. Now when depreciation, as far as depreciation is concerned, if the asset will be transferred or purchased at the end of the life, then you will take the useful life, otherwise lower of lease term and useful life. Lease liability, basically what you will do, you will prepare a table. The table will be your opening balance, interest, payment, closing balance. And there is also a requirement sometimes to classify between current and non-current. So what you can do is, whatever is the amount which will be paid in the, so if you are, let's say in year 1, year 2, in year 2 whatever will be paid here will be current for year 1 and balance will be non-current, or whatever is the closing balance of year 2 will be non-current and balance will be current. That is how you can remember. Now the next important part as far as examination is concerned is lease modification. Now what is the meaning of lease modification? There have been some changes in the lease modification. There are 2-3 scenarios. Please revise these scenarios as much as possible. There are questions on on these in the study material. You can have a look at them before you go to the examination. Now whenever we talk about lease modification, first one is based on right of use asset, second one is based on the term. Now if it is based on right of use asset, there can be increase, there can be decrease. If there is increase and if the additional ROU and price is commensurate, means say for example initially I had 1000 SFT, now I have added 500 more SFT. Now that extra price of 500 SFT and that extra asset that I am taking on rent, are they commensurate? Commensurate means are they in line with the market prices? The increase in scope and the amount that you are paying, are they in link, are they commensurate in terms of market prices? Then in that case you will treat that as a separate lease. Means earlier I had one floor, I added one more floor. The second floor's pricing is independent. Second floor's pricing is commensurate with the amount of space I have taken on rent, then you will treat it as a separate lease. If the pricing is not commensurate, maybe for the first floor I am paying 10,000, second floor I am paying only 5,000, which is let's say 50% less than the market rate. That means it is not commensurate. In that case, you will remeasure the lease liability and adjust the right of use asset. You will remeasure the lease liability and adjust the right of use asset, right? Then here you will not have any P&L impact. not having any P&L impact means whatever you are changing in the lease whatever change you make in the lease liability, the same changes you will be doing in the right of use asset. So there is no P&L impact, right? Then if there is a decrease means you have, let's say, vacated some portion, then you will remeasure the liability using a revised discount rate. You will remeasure the liability using a new discount rate. ROU asset will be reduced proportionately, meaning to say, if let us say earlier I have 100 SFT, now I have only 50 SFT. So whatever is the right of use balance, you will bring it down by 50%. New liability you will measure using the revised discount rate, and the difference will be charged to P&L. Okay. Now, when there is an increase in scope, when the price is not commensurate, where we remeasure the lease liability and use right of use asset, here also you will use the revised discount rate. Okay. Now, coming to the next part, which is term. If there is an increase in term, you will remeasure the lease liability using the revised rate and adjust right of use asset, no P&L impact. So, if there is an increase in term, you will remeasure the lease liability using revised rate and adjust the right of use asset, and there will be no P&L impact. If there is a decrease in scope, then you will remeasure the liability using revised discount rate, ROU asset will be reduced proportionately, and difference will go to P&L. So, now here if you see, here decrease in scope and decrease in term, the treatment is same. Okay. Increase in scope, if it is commensurate, new lease. If it is not commensurate, remeasure lease liability and adjust right of use asset. Here also, if it is an increase in term, remeasure lease liability and adjust the right of use asset, no P&L impact. There is one question where there is a mix of changes in term and changes in scope. Definitely have a look at that question before the examination. The next thing is whether we should account for lease and non-lease components separately, or we have to combine them into a single contract, right? Now, there can be a case where you have a lease component 1, you have lease component 2, and you have a non-lease component 1. Okay, there could be scenarios where all of these three are bundled into a single contract. Now, here if the entity can take the benefit from the asset either on its own or with other resources which are readily available, and asset is not highly interdependent or interrelated with other assets in the contract, then you will do the separation. This is applicable for lease components as well as the non-lease components. Okay, some examples: if there is a right to use property which is a lease component, maintenance could be a non-lease component. Okay, now when you have lease components and non-lease components in a contract, you have to allocate the consideration to the lease component and the non-lease component, or to the separate lease components. Now, there is a practical exemption which is available where a lessee can make an accounting policy choice by class of underlying asset to account for each separate lease component of a contract and any associated non-lease component as a single lease component. Means lease component and a non-lease component, if they are related, they can combine it together. Even if they are not related, if they want to combine, they can combine that together and they can account it for as a single contract. But the lease component should be, the non-lease component should be associated with the lease component, right? So that is one important thing. Second important thing is lease component. If there are two lease components, can I combine both of these? I cannot combine both of these. I have to separate them and I have to do the accounting. Similarly, we have a concept of contract combination where you have entered into two or more contracts nearby the same time with same or related parties, and they have been negotiated as a package with a single commercial objective. Consideration paid in one contract is dependent on another. ROU asset under different contract are a single lease component. If all of these conditions are satisfied, then more than one contract, you will combine them into a single contract. Now, this what basically means is, if I have entered into two contracts with A and B, with A I have entered into a contract for half part of the floor, half part of the building, and with B I have entered, who is a related party, with the second part of the building. Now, both these put together have been negotiated together. They are for the same commercial objective. We have negotiated rentals together. The amount I pay here is dependent on the amount I pay here. By considering all of these facts, what the standard said is, though legally there are two or more contracts, for accounting purpose A plus B put together, you will have a single right of use asset, right? So you have to combine those lease and create a single lease component, right? Now that is broadly what the lessee has to do when it comes to accounting for leases. Now as far as lessor is concerned, they have to do the classification as well. Lessee, there is no classification, even if it is an operating lease, even if it is a finance lease, whatever is the category of lease, you have a right of use asset to lease liability. Okay. Whereas when it comes to lessor accounting for lease classification, you have to see whether it is a finance lease or an operating lease. Now for finance lease, there are 5 conditions. Ownership has to be transferred at the end of lease term. If it gets transferred, finance lease. Option to purchase and lessee is likely to exercise. If there is an option to purchase and lessee is likely to exercise, then also it is a finance lease. Lease term for a major part of the economic life of the asset. If the lease term is for a major part of the economic life of an asset, then also it is a finance lease. Present value of lease payment substantially 90% covers the fair value of the asset. Here you follow 75%, and specialized asset that the lessor does not have any alternative use, then it is called a finance lease. As far as operating lease is concerned, if none of the conditions are satisfied, that is called an operating lease. Now, when the lessor has to do the accounting, the lessor will compute what one is called gross investment in lease. This gross investment in lease is discounted to arrive at the present value, which is also your net investment in lease. Okay. Now, as far as the gross investment in lease is concerned, it includes all the lease payments plus unguaranteed residual value. Now, lease payments, when we say, the lessee will pay, okay, the lessee will pay whatever the lessee will pay, fixed payment, in substance fixed payment, any lease incentives that the lessor has to pay, that will reduce, variable payments dependent on index or rate, residual value guaranteed by lessee. Now, residual value guaranteed by third party, which is not related to lessor, and exercise price of purchase option. Now, only this thing got added, which is a third party who has guaranteed, but the lessor will receive. So, whatever lease payments the lessor expects to receive plus any unguaranteed residual value makes the gross investment in lease, right. Now, how does the lessor do the accounting? As far as the finance lease is concerned, finance lease is where the risk and rewards have been transferred to the lessee. In that case, they will recognize a lease receivable, which is the net investment in lease. This is nothing but the present value of the gross investment in lease. Then he will credit the asset at the carrying amount, whatever is appearing in the books, and the difference will be recognized as P&L in the profit or loss. Okay, so whether it is a profit or loss, it will be recognized in the P&L. Subsequently, on this lease receivable, you will take opening balance, you will add interest, this will be interest income, payment received, closing balance. Okay, now this opening balance will include the net investment in lease. This payment you will have only from the lessee. Whatever is left over at the end of the period, that will be your residual value, one which is maybe guaranteed by the lessee, and the unguaranteed residual value, that will be the closing balance. Net investment in lease is the present value of lease payments and unguaranteed residual value discounted using the interest rate implicit in the lease. Here there is no concept of incremental borrowing rate. Sir, why did we have in the lessee? In case of lessee, the lessee does not know the lessor's incremental borrowing rate, but the lessor will be able to calculate what is its incremental borrowing rate, and hence here you will use the implicit rate of return. What is the implicit rate of return? Interest rate implicit in the lease is the present value of lease payments and UGRV, which makes the sum of fair value and initial direct cost of the lessor. Meaning to say, present value of these two should be equal to fair value of asset plus initial direct cost of the lessor. Small thing, in case of manufacturer dealer lessor, IDC is not considered to compute the IRR. Subsequent measurement of finance lease, as I told you, you will have opening balance plus interest minus payments and the closing balance. When it comes to operating leases, you will recognize in income statement the lease payments, the total of all the lease payments divided by the number of years on a straight line basis. If any other method is more indicative, then you will use that. Otherwise, you will use the SLM basis, or you will use any other systematic basis. Any variable payments will also be recognized in the P&L. The lessor will also charge depreciation on the asset, and initial direct cost, whatever is incurred, will be added to the cost of the asset. Then we have cases of manufacturer, dealer, lessor. These are those entities who manufacture and sell equipments, let us, or they are dealers, and they say, let us say, they sell cars. Okay, so they are entering into a sale transaction and in the form of a lease. So they are entering into a sale transaction in the form of a lease. Now, if there is a manufacturer, dealer, lessor, and there is a finance lease, then what will you do? You will recognize revenue as lower of fair value of asset and present value of lease payment. Lower of these two will be your revenue. Okay, why? Because applying more on the prudent side, what is the fair value of underlying asset? If I have an underlying asset of 1 lakh and the present value of lease payments is much more than that, then there is some other element which you have to look into. Okay, cost of sale is the carrying amount of the asset less present value of unguaranteed residual value. So what you have to understand is, this lease payments includes the payment that they will receive from the lessee and the third party. Okay. Now, this lease payments that you receive from the lessee and the third party, the present value of that will be received. So that will be my revenue as on today, or fair value, whichever is lower. Then cost of sale is the cost of the asset, what I am giving, minus present value of unguaranteed residual value, means what is the residual value that will remain with me at the end of the term of the lease, and the difference will be recognized as profit or loss. If lower interest rates are quoted, lessor recognizes profit considering market rate of interest. So, if you quote a very low interest rate, this present value of lease payments will be much higher. Okay. So, what you will do in that case? You will use the market rates of interest. Costs incurred by lessor are expensed at commencement and are not considered to be a part of IDC. So, if there are any initial direct costs, they are expensed immediately. If it is operating lease, no profit or loss is recognized in case of an operating lease because the control is not transferred. Please understand, we have to apply the principles of 115 to see whether the control has been transferred or not. Then, lease modification from lessor's point of view, if there is a finance lease modification, does it meet the separate lease criteria? Account for separate lease, as we have done in the case of lessees. If it does not meet, then would the lease would have been classified as operating lease since inception based on modified terms. So, based on modified terms, would it have been an operating lease? If the answer is yes, then this finance lease will be terminated and new asset will be recognized, that is net investment in lease before modification, and you will continue to recognize it as an operating lease. If no, then you will apply IndAS 109. So, as per IndAS 109, the modifications to the contractual terms and all will be taken care as per IndAS 109 for financial assets. If operating lease has been modified, then there is no problem, account for a new lease. A new lease means the operating lease terminate the existing lease, account for a new lease. So, operating became finance, operating lease terminate and account it for a finance lease. Any prepaid or accrual of lease payments is treated as payment for new lease. Okay. So, if there is any prepaid or if there are any accrual of lease payments, if there is something to be received from the lessee or something has been received in advance, then you will treat as if it is the payment towards the new lease. Then we have another concept of sublease, which is where an underlying asset is released by the lessee. So, there is a lessor, the lessor has leased it to a lessee, the lessee further leases it to a third party, right. Now how do we account for subleases? If it is a short term lease, if the head lease is a short term lease, means the lessee who has taken it, so they basically you have lessor, you have lessee and then you have sublessee, okay, and he becomes the intermediate lessor. Okay. If the head lease is a short term lease, then the subsequent sublease that is done, it will be an operating lease and you will account for it as an operating lease. If the head lease in any other cases, you have to see whether the sublease is a finance lease or an operating lease. If the sublease is a finance lease or an operating lease, depending on the criteria. So, if it is an operating lease, the original lease does not get impacted, you will do a separate accounting for operating lease. Whereas, if it is a finance lease, if the sublease is a finance lease, means I am transferring the risk and rewards, then the right of use asset which this lessee has recognized, that will be de-recognized and you will recognize a new investment in the lease and you will continue to do the accounting for finance lease, and the original lease liability from lessor to the lessee, that will continue in the lessee's books. Okay. Now, why this short term lease we do not classify in these two criteria? Because in case of short term leases, it cannot be a finance lease, right. So, that is where this classification does not arise. Now, in case of sale and leaseback transactions, we have a buyer and there is a seller. So, the seller sells the asset to the buyer, buyer again leases back to the seller. So, buyer becomes the lessor, seller becomes the lessee. It is negotiated as a package. Now, here the most important thing that you have to understand is whenever the seller is selling that asset to the buyer and taking it back on lease, they are taking back or they are retaining the right to use a part of that asset or right to use a specific proportion of that asset. Now, the principle here that you need to understand is if any right has been retained, then on that component you cannot recognize profit or loss. So, the seller can recognize the profit or loss only on the portion that has been transferred. Also, we have to see whether the lease rentals, they are in with respect to market terms or not. Also, whether the sale transaction is with respect to market terms or not. Sometimes what happens is the seller has sold, let us say the fair value of that asset is 100, selling price is 120. Now, why are we selling at a higher price? We are selling at a higher price because when we sell, the buyer pays us higher amount, 120. And subsequently, when we take the asset back on lease, we will pay a higher lease rental. So, it is kind of a financing. So, if the selling price is higher, it is a kind of a financing that we have to keep in mind. Okay. Now, we have to do certain fair value adjustment if the transaction is not at fair value. That is, the value value of consideration for sale of asset is not equal to fair value, or payment of lease are not at market rates. So basically, if when you sell it at a higher price, then as a lessor, the buyer will recover higher amount. So there are two components. One is towards the lease component. Second one, there is an additional financing. Okay. So how do we adjust for fair value differences? Check which is more determinable. Means what? Either difference between sale consideration or fair value of asset, or present value of lease rentals and present value of market rentals. Whichever is more determinable, first determine that. Second, if the sale price is greater than the present value of lease rentals, the difference is reduced from sale consideration and treated as additional financing. So whatever amount is additionally received, it is treated as an additional financing. If the sale price is less or the present value of lease rental is less, meaning to say fair value is 100, selling price is 80. Why will someone sell at a lesser price? Because subsequently we want to reduce the rental. So that reduction, basically what happens, buyer pays, let us say 80 to seller. Buyer has paid 80 to seller. Actually the buyer should have paid 100, but buyer has paid only 80. Can I say indirectly 20 of benefit has been given by the seller to the buyer? Now seller subsequently become the lessee. Seller will subsequently become the lessee, and that lessee they will get the benefit. So it is kind of a prepaid rental. So the difference is considered as prepayment for measurement of right of use asset. So two things. If the transaction is not happening at market price, you have to see which set is more determinable, present value of lease payments or the market price, right? And once you decide which one is better or which one is more determinable, then you will see whether the selling price is greater or lesser than the market value, or the lease rentals are greater or lesser than the market value. So two categories. If the sale price is less or the lease rental present value is less, of course when the sale price is less, only then the present value of lease rental will be less, then in that case difference will be treated as a prepayment and added to ROU asset. If the sale price is greater, then we will treat it as an additional financing, right? Now this is for fair value differences. The normal sale and leaseback transaction, if control is passed, recognize as sale and purchase and account for leases. Okay. Now how do we account for leases? See, whenever there is a sale and lease back, okay, you sell at some value and there is a lease back. This lease back has some right of use asset component. Now to the extent of right of use asset which I am retaining, that amount should not include element of profit. So what happens is, the portion that is retained, portion of what? Portion of the carrying amount that is retained will be the right of use asset. Portion of the carrying amount that is retained will be the right of use asset, and the portion on that one portion which is transferred, on that portion you will recognize the gain or loss, okay, and you will apply the lease accounting. That is as far as the control criteria is concerned. If the control is passed, sale is recognized, and once you recognize the sale, you will not recognize profit or loss on the full amount. You will recognize the profit and loss only on the transferred amount. The amount which has been retained, on that portion you will not be recognizing any profit or loss. The retained right of use asset will be accounted for at the retained portion of the carrying amount only, without any profit element, and if the control is not passed, then you will continue to recognize asset because you have not passed the control. Buyer cannot recognize the asset and it will be treated as a financing transaction under IndAS 109. Okay. Do practice the question based on sale and lease back from my material. So we have this transition approach. Now it has been a long time that the transition has happened, but nonetheless I would suggest you to at least practice the question of transition, so that if it, because see there can be a transition from accounting standard 19 to IndAS 116 also, right? Of course it's a first time transition, but again that is important for you to understand. Okay. Now when it comes to transition for lessee, one is a full retrospective approach, meaning to say restate everything as if IndAS 116 has always been applied. Modified retrospective approach means you will not restate the comparative. Difference between the asset and liability recognized will be adjusted in the opening retained earnings. Okay. Now there could be two scenarios. It could be operating under previous GAAP, it is finance under previous GAAP. If it is operating under previous GAAP under modified retrospective approach, then the lease liability is present value of remaining lease payment, and right of use asset is either take it as per IndAS 116 or take the lease liability, opening lease liability plus or minus prepaid or accrued lease payment. See, under operating leases, because you follow SLM method, there could be some prepaid or accrued lease payment. Okay. So if it is operating, lease liability is nothing but the present value of remaining lease payment. Right of use asset is take as per IndAS 116, calculate afresh, or take the lease liability and adjust the lease prepayment or lease accrued, right? That will become the right of use asset. This difference will be recognized in where? It will be recognized in opening retained earning. Second, finance lease under the previous gap. Then you will recognize right of use asset and lease liability as per previous gap values only. This is the modified retrospective approach for leases. Then we have some recognition related exemptions. A lessee may not elect to apply IndAS 116. Then we have recognition exemptions. A lessee can elect not to apply 116 to short-term leases less than 12 months. But yes, if there is an option to purchase, you cannot take this exemption. Leases for which underlying asset is of low value based on the entity's judgment. So if there are low value leases, there also you can apply that.